Yos.
Okay, welcome in everybody to the webinar of the month. We've been working on this one for a little while, and of course, all events that are going to be leading up to this. Make sure that you don't leave prematurely. We have an announcement midway about the courses that are coming up and information that you just might want to know to make decisions in the next 3 weeks or so. So we'll be having that midway. Just a little bit of a housekeeping. Remember when you come in to make sure that your mic is muted. Some of you have background sounds. Of course, I will do my best to mute everyone. I have set it to mute everyone upon entry, so that shouldn't be an issue. Let's hope. And let's go through the agenda very quickly for today. So today's agenda is really simple. We will have the first part, which will be driven by Andrew. He will be going over evolving to a market maker mindset. How do you get into that mindset? And then followed by, I will start covering the intro to the bond market, how money supply works, the Fed, and just overall what to expect in the next couple of weeks as we head into a period where you're going to get your first rate cut. And then we'll have a little bit of a break, about a 5-minute break, which we'll also double up with announcements. And then we'll start back and jump straight into the intro to the wheel cycle, followed by Andrew will close it off with the social media versus real strategies in real life. And then we'll open it up to you guys for Q&As. Now, just also to kind of give you a little bit of understanding, this session is taking over the Sunday prep session, but tomorrow the market is closed. So therefore, very likely during tomorrow, the same time, or is it going to be in the morning of the next day, we'll hold the regular Sunday recap, Sunday prep webinar. Okay, so that will be pushed one day. So it's just perfect that tomorrow is a holiday, stock market holiday, so it works out really well this week. Okay. So I'm gonna go ahead and hand it over to Andrew to start, and he will get on with the first part of this.
All right. Yeah, we'll just leave it on yours. That works. All right. Oh, you went too far. Go back. There we go. All right. Evolving into the market maker mindset, right? So we've been doing this for quite a while. When me and T started collabing, one of the things that we talked about was we wanted to, one, help reshape people's minds on what it means to trade or invest in the stock market. And that's kind of why we started this journey and we started collabing together. When you think about day trading or you think about being a trader, right? And these are kind of the terminology that people wrap their head around. It really comes down into two, right? There's retail and then there's institutional, right? And retail is what you see on social media. And so the images that come to mind when you think of retail, right, are fast money, right? Nobody is posting on social media and like, hey, if you buy S&P 500 and compound it year over year, in 30 years, you'll be set for life, right? They're selling you a dream in order to get you to buy a course. So real quick, just to the group, if we think back, previous years before COVID, before day trading was the flavor of the week. What were some other business models that you remember that people were trying to sell people a dream? I can think of one right off the bat, timeshares, right? If you remember way back, everybody was trying to sell everyone timeshares. I remember countless people trying to sell my parents timeshares, right? And all I remember my dad always telling me is it's a scam. Like this is all just a scam. We stay away from it. So I was like, okay, Herbalife is another one, right? What was the other one? Prime America. Hey, you can come sell life insurance to your family and make thousands of dollars a month and drive Lamborghinis, right? It's always you can make thousands of dollars a month and drive Lamborghinis or Ferraris, right? It's always the same. And now if you go to social media, it's the same thing. If you look at a social media page, what is it? I day trade for 15 minutes and then I drive my Lamborghini to the gym. And it's literally the same model for every single one of these groups. So when you think of retail, these are the things that come to mind. These are the things they sell you. Fast money. You can make money. Airbnb is another one, right? You can, was it FBA? Is that what it's called? That
Yeah.
Amazon business. You sell things on Amazon. That's another one, right? So there's lots of different ones. But essentially, it's fast money, right? You don't need a lot of money and you can make a lot of money. If you give me money, I can make you a lot of money. Then it's the Lamborghini, right? It's always a Lamborghini for some reason now, but it's the Lamborghini, right? If you day trade with me, you can also drive a Lamborghini. Then it's the freedom. Well, you work a 9 to 5 and you want freedom. So you got to do these things. Then it's the house, right? Then it's the news, right? What is retail looking at? They're looking at the news. So these are all the things within your mind as a retail trader that you get sucked into when you think of day trading. And the reality is, when you look at the institutional side, you don't see those things, right? You don't see them talking about, oh, I'm just going to drive my Lamborghini after work, right? If you look at T, you look at myself, you look at, I mean, if you guys remember Boomer, when I used to post things from Boomer, it would be 1 o'clock in the morning and we would be getting updates of things that he was looking at, right? And that's why the other side of this screen is the data side, right? We're looking at the information that's going to help us better understand what the market's going to do so that we can take advantage of it. All of this stuff on the left is what they're selling. Now, if we posted all this on social media, right? We just posted, hey, this information, dark pool activity, whatnot, right? What do you think is going to get more likes? You think if I post a screenshot of dark pool activity from Friday, that I'm going to get thousands of likes? Or if I post a picture in a Lamborghini with $50,000 on my laps, it's going to get thousands of likes. Which ones do you think is going to get more likes? It's a very simple question. I just need one answer. Yeah, it's going to be the Lambo, right? In reality, people don't care about the data. They don't care about the information. They care about status. They care about image. And when you think about market makers don't care about the status. The only thing market makers care about is taking your money. Remember that when the market opens, and we'll get into this when we go into the social media side, right? The first thing the market makers try to do is engineer liquidity, right? And who is the liquidity? Do you guys know who the liquidity is for the market makers?
Retail.
Retail is the liquidity. So when you think about it, on the left side, when you're a retail trader and you're thinking through this mindset of fast money, in and out of the market, drive Lamborghinis, go on big trips, trade while you're on trips. That's the other thing, right? They're like, well, I just got my laptop here and at the islands, and I'm just going to make a quick little trade here and pay for my whole trip, right? In reality, the market makers, which are the ones who control the stock market, which you guys will see later on when we start to go through, how all of this works, the first thing they're going to do is engineer liquidity through taking advantage of the retail traders, and then they're going to drive the price to those data points based on where they're positioned. So the biggest thing as we get ready to go into T's part, because T is going to be going into the bond market and money flow and all of these things that really tie into how the interworkings of the market works. T likes to call it the plumbing of how the stock market actually works. The first thing you need to understand is that when you have this idea, right, on the left side of retail, and this is why you got into trading, the right side, the data, the information you need in order to be successful is not going to make sense to you. Now, the whole goal of this is to continue to grow you guys as individuals. So later on, we are going to announce one of the classes that we're going to do, which is going to dive deeply into these data points, where we will spend hours going through what does each of these mean? How do you use this information to your advantage so that you can be successful within the stock market and change the way you look at things to be able to take advantage of those opportunities when they present themselves, right? Engineering liquidity is when they push the price down or up in order to shift the market sentiment. And then when the market sentiment shifts, they slam it back down the other way. So essentially, for them to get out of their position or get into a position, they need to move the market in a direction to get everybody make stop to get everybody to purchase or sell their positions. And when they sell those positions, they're selling them to the market makers. And then once they get into their position, then they can move the market into the direction that they want to move it into. So it's essentially what we call, a liquidity sweep or a stop hunt, right? It's the same thing. They see an area of the market where a lot of people are sitting. They push the price into that area. Once they fill their orders, then they shift it the other direction and they profit massively. So, my biggest ask for you guys as you go through this webinar, I like to call them what the fuck moments or WTF moments, is when T is talking through the bond market or talking through the money flow and how things work. If he says something that you're like, wow, I never really thought about that, right? That's a what the fuck moment where you're like, I wish I knew this prior because this would have helped me be more successful in identifying where the market is actually at versus freaking out over every piece of news that comes out. Because if you guys know something, you've been in my group or you've been in T's group, is one, we don't care about the news. We don't care about the news. We don't care about Johnny Tsunami, whoever on social media talking about what he thinks the stock market's going to do. I post that one dude all the time just for fun because he calls the top like at the end of every close. And then we go higher. And he's like, yeah, I called that top again. Like, what? I don't know what you're talking about. Um, is when those moments hit you, just comment them. That way everybody can see like the things that you're taking away from this webinar, and it'll help everybody grow together. So the biggest thing to think about is retail is still living in this fast money status quo, right? Posting on social media, likes are, their euphoric moment. And institutional traders or market makers are very data driven, are very numbers driven. They don't care about those things because they're already highly successful and they're not trying to showcase that success to anyone, right? Also remember that a lot of this data driven stuff is supercomputers with AI technology. It's not actual individuals. It's called high frequency trading. And it's supercomputers making decisions at lightning fast speeds based off of this data, which is why it works so successfully. So, those are the things I want you guys to take away as we evolve from this retail mindset of we're all here to get fat, fast money, and drive Lamborghinis to we're actually here to learn and grow and understand how this data works so that we can use it to our advantage to grow our portfolios year over year. So, with that, I'll hand it over to T. He's going to walk you guys through the meat of what this webinar is about.
Okay, so I think that for a very long time, a lot of you have been asking me to do explanation of the bond market. So this is the one time that we will be looking at this again. Now, um, also to mention that I have done a webinar on this prior in 2022, which was exactly 3 years ago. Now, I'm mentioning this because it's important that at that moment, we were entering a quantitative tightening cycle, where interest rates were about to go higher. And now we are in the exact opposite scenario, and hence the reassessment of this topic, because as we head into quantitative easing, there are a lot of things that will change. So where you saw this explanation of this exact same market 3 years ago, now you're going to see the exact completely different side of this. Okay, so let's get into the intro to the bond market. Okay, so first of all, Who issues bonds? Well, bonds are issued for a variety of different reasons. Okay. And there are many different types of bonds. So the first type of bonds that I want to discuss are typically called treasuries. Okay. And treasuries are something in which we are constantly looking at throughout our, cycle of where monetary policy is, right? They are very tied and linked to all instruments that are within financial markets. It usually forms the base rate of return for any investment. The reason for this is because treasuries, and by the way, treasuries are named many different things. They're named treasuries, they're named bonds, they're named notes, they're named bills. There are many different names because they have different use cases. And when we're talking about treasuries, we're talking about the fact that they are backed by the United States government and they will not carry a risk. It's a zero default risk. Okay. So for that reason, when you learn finance in school, they will always call treasuries the risk-free rate because it is risk-free. It's backed by the US government. They will always pay it. Okay. Now, I know that in recent times, there have been a lot of conjunctions of the market where participants, the godfather of economics or some random furu will say that, hey, these debt levels are unsustainable. And I will get into that a little later as to why the US debt problem is not as big as some people think it is, but it's not as small as what some people think it is. So it's kind of in the middle, very weird status quo. Okay. So people who are looking to hold cash, okay, typically smart investors would never hold their money in cash. If you are one of those people that stores $100,000 in a high yield savings account, just understand that almost half of that, or more than half of that, is being eaten away by inflation every single year. So, what do investors do to combat this? Well, they simply put their money into a risk-free set that pays them more or equal to the rate of inflation. And that usually turns out to be bonds. Okay. Now, there are other type of bonds, as of such, the ones that are issued by corporations. For example, if a business like SoFi or a business like Robinhood wants to go and expand their business, they have a couple of different options. One option is they go and sell shares. They go and dilute their own shares, right? Investors don't like that. A second way is they go borrow money from a series funding where investment banks help them to kind of get that funding and then they collect it through a series of funding. The third way is if they raise corporate debt. And how do they do that? They do that through selling bonds. So this is usually when that case happens and it carries a higher risk and a higher reward. These bonds typically outpay high yield savings accounts. And because the agencies that are rating these bonds, they rate them as credit worthy, then they earn a high level of certainty of payback. Okay. So investors then lend these corporations money to carry out its operations or its expansion, and then they get a payment back. Okay. Now we'll get into the anatomy of a bond in a second. So remember what I'm talking about here because this is all going to be linked together. Okay. Now the third type of bond that exists is municipal bonds. These are bonds that you lend to on the state level. So in America, you have federal level and then you have state level. So the federal bonds are treasury bonds. The state level, you have municipal bonds. What are municipal bonds done for? They help to pay for capex. What is that? Roads, bridges, schools, infrastructure that belongs to the state, basically. Okay. And these bonds, the interest paid on them, the coupon payments are typically tax-free, which makes them an attractive investment for rich people to park their money while receiving interest. Okay. So really simple. You have three very specific types of bonds. And that's a very nice intro to the bond market. Okay. Now, heading into the anatomy of a bond, we need to understand what a bond is, how it works, and then you can understand the system behind it. So you realize I'm not jumping in by talking about the Fed and the open market operations and money supply and this and that. No, you need to learn how to first crawl before you can walk, and then you walk before you can run, right? So we're going to take a step-by-step approach here. So bonds come in many different maturities. What is a maturity? Simply, it's like the options expiry. Okay, there's an expiry date for the bond. You're lending the money to the United States government for a specific period of time, And this period of time ranges from 1 month all the way to 30 years. Okay. And there are many different frequencies and different types of thresholds that investors are looking at based on their risk appetite. Some person may be very comfortable lending that money for 6 months because they don't need it. But another person may be very comfortable lending that money for 30 years because they truly don't need it, right? So because of the varying degrees of investment requirements, these bonds are staggered into time frames, okay? And when we are talking about a bond which is purchased, it is purchased either in an environment where it is at a premium or at a discount, okay? When a bond is at a premium, okay, its price is higher, but its yield is lower, which means that the people who are buying this bond, right, are influenced by that supply and demand dynamic. Okay. And remember that they're lending this money based on the growth expectations of the economy. Okay. So here in specific bonds, there are some bonds that pay coupons annually or semi-annually. But right before I get into semi-annually and annually, what are coupons? So how a bond works is like this. Essentially, they come in blocks of $1,000. Okay, to make it really simple. The value of the bond is $1,000. On top of the $1,000, you either pay a premium, okay, or you get a discount. Okay. And so it's either less than 1,000 or more than 1,000. Okay. And what you do is you pay that value and then you own the bond. So it's either a discount bond or a premium bond. And then when you're holding that bond, what happens is you receive coupon payments. That coupon payments can come annually, semi-annually, monthly. Okay. There are different frequencies depending on the bond that you buy. Okay. And what is the coupon payment? The coupon payment is like a dividend. Think about it like a dividend. So essentially, during that frequency, you receive a small payment for holding the bond. And that small payment, the coupon payment, is what we call the yield on the bond. Does everybody understand what I'm saying so far? If you understand what I'm saying so far, just very quickly say yes in the chat so I can continue. Okay, so far so good, right? Nothing crazy, no complicated stuff, right? So very simply remember the rule that bonds with higher risks will always pay higher coupon rates, okay? Or higher yields, basically, right? And at the end of the time period of that bond, what happens is that you will get back the face value of the bond, okay? So after you're done, let's say you decided to buy a 3-year bond, within that 3 years, you'll receive a bunch of coupon payments. Remember, you paid the initial $1,000, right? Or the discount or premium bond. And then the end, you'll get the value of the bond back and all the coupon that was associated with it. So that's how bonds work. It's like buying a dividend paying instrument that's paying you out over time. Okay. All right. So now, how big is the world's bond market, first of all? And then who is, the leader of that, right? So you can see that the US actually makes up for 52% of this, right? Right behind the US is China, then is Japan, then is France, then is Germany, then is UK, Italy, blah, blah, blah. And obviously after these are too small. Like you can see Canada, right? You can see Italy, you can see India, right? So these bond markets are too small, so I didn't really put them in there so aggressively because it really makes up a small piece of the pie. But essentially, that there are a lot of market participants that are providing debt to all these countries. Okay. And it's not just one country that has more debt than another. The country that I'm from, Singapore, for example, has debt. We have debt. We have a lot of debt. But is the debt a problem? No, because there are underworking issues within the government that ensures that we are borrowing at a responsible rate. Okay, so now a lot of people would say in their head, oh, but US is borrowing unsustainably. Well, I can actually come up with 3 to 4 very good negating points to argue against that. Okay, I'm not going to do it now, but I just want to say that there are very, very specific things against what people say. Okay, so how does the US debt break out? First of all, right? You'll realize 35% of it is treasuries. Okay, so it's not all the debt that is treasuries. Okay, then you have corporate debt, that's 20%. You have mortgage related debt, that's another 20%. Municipal, which we just discussed, 9.6%. Money markets, 2.3%. Agency securities and asset-backed securities, those are making up about 7 to 8% in total. Okay, so you can kind of see how big of the piece of the pie is here, and you understand which are the markets that are actually leading or lagging in this. Okay. All right. So as I was explaining earlier, you have the structure of the bond, which is the anatomy, but then you also have the reaction of the bond based on economic concerns, right? So the blue line here is a bond that is trading at a discount in which the yield is higher. Now, why is the yield higher? Because they want to attract people to buy this bond, okay? And if the yield is lower, that means that this is a crowded bond, and therefore it's more expensive to buy because more people are crowded into this bond, right? And then you have the regular face value bond, which is at 1,000, and that's your vanilla, like normal price, right? So when we look at this, what are we trying to actually understand? We are trying to understand what is the supply and demand of this bond market, okay? And when interest rates go up, then the prices of the bonds will go down. But now we have the reverse scenario, right? What are we expecting? We're expecting interest rates to come down. So therefore, what's going to happen to the price of bonds? They will go up, right? So with lower rates or yields that are coming up, new bonds will be issued and they will yield less than the older bonds now, right? So the prices of the bonds will go up. And if you want to sell your bonds, you will now have to sell your bonds at a premium. Okay, so I'm using the reverse of this now because that is the situation we're entering into, right? So when you are talking about this specific interaction, it is important in understanding yield curves. All right. Now, you would have heard the yield curves every time that there is an economic uncertainty. The godfather of economics will always come on CNBC and tell you that the yield curve is inverted and the data suggests that there's going to be a recession within the next 6 months. Didn't we have that exactly 1 year ago? You know this. The news is posting all about it, right? Did we have a recession? We didn't, right? Is it coming in the future? We don't know, right? But to try and guess and to try and predict is stupid, right? So what is the yield curve and why the hell do you need to care about it? Okay, so the yield curve is a visual guide as to how yields across various maturities of the treasuries are varying based on economic concerns of investors. You see, the bond market is the beginning place of where all money is lent and borrowed, right? So it is almost like the plumbing of the markets in general. Money that comes in the stock market is from usually the bond market. Okay. And what happens here is as money comes in and out of the bond market, it either goes in and out of the stock market and commodities and derivatives and your other buckets of different instruments, right? So the yield curve is a measure of the cost of funding for this debt, for the varying maturities across the entire economy. Okay. And as I was mentioning earlier, the US and Germany are the only two countries in the world that are actually considered risk-free. Okay. And because the reason is because people trust these two economies. They're stable economies with stable political structures, strong growth, and majority of the biggest tech companies, obviously, you guys know, is in the United States of America, right? So there are two types of yield curves. The first being the normal yield curve. This is when financial conditions are loose, okay? And this is when long-term maturities command higher yields than short-term maturities. So imagine if you're a bondholder of a 30-year bond, that's 30 years from now. Can you guess what's going to happen in 30 years from now? No. But the default mode of the stock market is that the longer term of the market, the longer the period you're looking out, is more uncertain. Therefore, investors are commanding higher yields. Okay, you can see the yield here and the term to maturity. So imagine this is 0 months, 1 year, 2 year, 3 year, 5 year, 10 year, 20 year, 30 year, right? So the 30-year bonds will always give you the higher yield because of the economic uncertainty in the long run. That is the normal bond market. And because in a normal yield curve, the short-term economic sentiment is more predictable and people are not freaking out anymore, the short-term maturities always give you the lesser yield. Okay. So this is the default structure of yields because the longer term is uncertain and then the issuer is not sure about what's going to happen. Therefore, it creates a higher risk to reward ratio structure for the longer term. Okay. Now, what about when we have an inverted yield curve, right? An inverted yield curve means it's the opposite. It's when financial conditions are tightened, right? That's what happened in 2023, for example, right? We had an inverted yield curve. This is where short-term maturities now command higher yields. Why? Because the short term is uncertain. The long term now becomes more certain. Bond market holders are typically trying to, sorry, someone's drawing on the screen right now. Long-term bond holders are typically looking for that more stable return, but therefore they get a lower yield for that because investors are thinking the short term is so volatile that I don't want those bonds anymore. So they sell the short-term bonds and the yields of those bonds become very, very high. Okay. And you will realize the middle term also gets slightly affected as well. And then the long term, the yields come down very, very sharply because the longer term is basically a bit more certain. Like if things are already messed up now, the chances are for it to improve are very high, right? So therefore, the yields of the longer term bonds come down. Okay. So people start rushing towards the fat end of the bond tail, which is the right side. Okay. So now you'll hear me say things left side, right side. Middle is 10-year bond. 10-year bond is the most commonly sought after, is the most liquid bond. Okay. So does everybody understand the yield curve so far? Is everybody good with the yield curve? It's a very simple concept. Now, just to also give you a bit of a understanding of this further, this is the yield curve right now. Okay. So you can see here, this is today as of Friday. As of today, it still hasn't changed, right? Because market's not open. But you can see the yield curve now, right? So you can see the right tail, 20-year, 30-year yields are still pretty high. The left tail, the yields are at 4.4, is a bit lesser, right? So now, which one of these scenarios are you most similar to? Well, you can see that we're kind of in between this scenario and this scenario, right? So you can see the bottom part here now is starting to cave, right? And when the Fed starts cutting rates, what's going to happen is this part of the yields, right? It'll start to move further down, and then this part will go up, and then this part will stay high, right? So you can see people are already crowding into the fat tail of the bond market, right? But right now, the most crowded trade is 2 to 5 year yield, right? So everyone's crowded into these bonds right now, the 2 to 5 year period. But as the monetary policy improves, you'll see this will start to come down because the short term will become not that interesting to hold anymore. And it'll become more stable. And then the longer term will become more uncertain, and that will continue to see higher yields. Okay. And this will be the least crowded part of the bond market, right? So you have to understand all of this before you can kind of understand the economic sentiment. Okay. So we're good with this? Yes? Okay, great. So now the next part of this is going to come into the Federal Reserve. How does the Fed play into all of this? Okay. So first of all, you have to understand the structure of the Federal Reserve. Okay. So the Federal Reserve, or the federal banking system, is made up of a variety of different sub sections. Okay. The first is called the Board of Governors. These are 7 members appointed by the president to 14-year terms. If you remember, I think Trump just fired one of them, right? Last week, I think, right? And what is their function? They supervise and regulate the Fed. The thing about the Federal Reserve is they cannot be politically motivated. They are controlling economic policies that are going to affect everybody. And so therefore, this arm of the government is largely meant to be independent. But is it truly independent? No, because as Democrats and Republicans try to fight for space in the House or Congress or the Federal Reserve System, there's always going to be influence, right? Just the same way how Trump fired that lady last week, right? What is it for? It's so that he can have influence. He's not been, what do you call it? He's not been dishonest about it. He's like I want rates to be cut. He has said publicly multiple times that he wants rates to be cut because he knows that it will drive the prices of everything up, right? And so there is one, which is the board of governors. Then you have a council, well, a couple of different councils. You have advisory councils, you have federal advisory, consumer advisory council, then you have thrift institutional advisory council. So you have a variety of different councils. And these people all basically advise the 7 members of the Fed. Okay. Then you have a separate committee. Okay. And you guys know the most about this committee because you see it every single month or every other month sometimes. It's called the FOMC, the Federal Open Market Committee. Now, this consists of 7 members of the board governors, 5 presidents of the district banks, which are a total of 12 members. Okay. These 12 members sit into a room on a very often basis, and their job is to decide on monetary policy. Okay. Remember that the Fed has a few different mandates. One is stable unemployment. The next is stable borrowing systems. The next is making sure that monetary policy is at a certain level, and then inflation, right? So they have like a very few mandates that they have to rule in. And so this group of 12 people are the ones that decide where monetary policy will go to. Okay. Now, on top of this, remember that there are 12 district banks for the 12 districts. Okay. You have like New York, Georgia, you have San Francisco, I think is one of them, or California has one, right? And so they all contribute and receive funds and stock from the member banks. Now, member banks make up the banks in the fractional reserve system. For those of you that don't know what the fractional reserve system is, simply the banking system in which banks can have a deposit of $1,000 and then keep 10% of it and lend 90% of it out. That's the fractional reserve system. Okay. So there are 2,650 approximate national banks and then 1,000 state banks, out of which 2 years ago or 3 years ago, you had a very big fallout or a very big problem with the what was it called? The SVB fiasco, right? That's also the last time that I did this webinar, by the way, right? It was the Silicon Valley Bank that exploded, right? So that's what you need to know about the structure of the system. Okay, so now I'm gonna go and expand on the FOMC and their functions. Okay, so we're gonna talk about how the bond market interplays with the FOMC. How are these two things related? Then how is this whole thing related to the stock market? Because if you understand this from a deep level, you will look at the stock market as a completely different place. Okay, so let's dive into it. So you have this is basically how money supply works. Okay, this is how the entire system works. Okay, so you have the Fed on the left. Okay, and then you have basically either a increase or a decrease in the Fed's balance sheet. Think of the Fed like a business, okay? But it's a business that has never-ending amount of ability to provide liquidity and funding. And they are the last resort lender if something fucks up, right? So essentially the Fed will step in. If something goes wrong, they will be the ones to provide liquidity. They will be the ones to fix whatever that's going wrong, okay? And because of this, they have to take on risk sometimes, which means that that risk is on their balance sheet, okay? And sometimes when things are better and the economy is doing better, what they will do, they will offload that risk, okay? So they will take some of that risk off their balance sheet. Now, that's you, and that's businesses that you own, which generate goods and services, right? So individuals or businesses generate goods and services. In order to get goods and services out, what do they need? They need capital, right? And if today I told you that the cost for capital is much higher, you would simply borrow less capital, okay? And that's how money supply is controlled. If things get too expensive, if inflation rises, right? If things get out of control in terms of pricing, where housing becomes too expensive, what does the Federal Reserve do? They raise interest rates. However, they don't raise interest rates in the way that you think they do. It's not like the 12 of those people in the FOMC meet up and then say tomorrow the rates are going to be this. They do decide the target range. It's a range, right? Usually from 5.5, 5.25, or 4.25 to 4, right? The range is what they decide on. But why is it a range? It's a range because they have to control money supply to then get towards that range. Okay. So right now, if you look at what is the existing interest rates, they're about 4.33%. And in 2 weeks from now, the Fed will then cut interest rates and then it'll become lesser, right? Now, if you're a bank and the Federal Reserve has cut interest rates, well, guess what? You also have to cut your rate of return to the consumer, right? So the rates that will be borrowed, people will be borrowing at, will start to decrease now. Banks were enjoying high interest rates for the past 2, 3 years, right? And so I think somebody asked me a question the other day. So how will banks now circumvent the situation? Well, they will adjust based on what the federal funds target rate is. But how does this system work? That's more important, right? Okay, so you need goods and services to be sold. You need capital in order to do so, right? Well, you have to go to a bank to do that, right? Where does the bank get its money from? It gets the money from the open market operations, which are run by the FOMC or the Federal Reserve, okay? Remember when I keep showing you guys about RRP, the reverse repo, which is this thing right here, right? This is the funding overnight for the Federal Reserve. But remember, that is not the Federal Reserve that is necessarily lending this money to the banks. They do, but it's not through the way that you think they do. Okay, so let me clarify this for you. How do banks borrow money from the Federal Reserve? Well, that is done through two functions. The first function is where they borrow or they buy and sell bonds. Okay, now you see how everything is coming together. So the Federal Reserve has a balance sheet which makes up of many different instruments. Some of them are mortgage-backed securities, some of them are bonds, some of them are other municipal things. There are various different types of assets at the balance sheet. Okay, but if the Fed wants to put money into the system, right, they have to sell bonds. Okay, so they sell the bonds to the bank, right? The bank will then give them the cash, right? And that's how that quantitative tightening happens, which was in 2023, 2022, 23, and then 24. Now it's starting, it was loosening, and 25 is now where we're fully loosening. What is the opposite? Now, when the Fed wants to inject money into the system, right? They will have to sell bonds. Okay. So, sorry, am I saying it right? Yes. Yeah. So they will give, they will sell bonds. Yes. So they will put money into the system and take those bonds back. Oh, sorry, they will buy bonds. My bad. I'm mixing it up right now. They will buy bonds, right? So they will take bonds in and cash will go out. Okay. So, but then in your head, you must be thinking, but if they're selling those bonds or buying those bonds, what about the old bonds that they were holding, right? So like if the rate suddenly went down, then there would be a whole bunch of bonds that are outstanding at a certain maturity, right? What would happen to those bonds? Well, the Fed will then offer a lower cost structure for them in order to incentivize banks to buy those bonds. Okay, so it's a very simple system. They take on the risk onto the balance sheet. They will either buy or sell bonds to create the liquidity in the system. Okay, so these bonds that we're talking about are treasuries. Okay, and who owns a lot of treasuries? Banks own a lot of treasuries because it's part of their reserve ratio requirement. Okay, so when the Fed wants to perform quantitative easing, they will put money into the system and take bonds back. Okay, so they sell bonds. Okay, and if they want to tighten the system, then they will take money in and they will sell bonds. Okay, so either way, bonds are moving in or out of the system. Okay, it's one function or another. Okay, if I'm mixing something up, please tell me, because I do tend to mix this part up sometimes. It's one of those messy ones where it's a bit confusing sometimes. So money goes out from the Federal Reserve only if bonds are taken in. Bonds go out from the system only if money is taken in. There are only two functions to this, and this is how money interacts with our system. Now, this money goes to the banks, correct? It's through the overnight operations, which is what we call a repo system, okay? Reserve repurchase agreements, which are overnight functions of the bank. However, the interesting thing is this money is then lent intraday to other banks. This is what makes up the target monetary policy rate. Okay, so the rate that you see, that target rate, is actually the rate at which banks borrow from one another. Okay, it is not the rate at which the Federal Reserve is lending that money to the banks. That is a different system altogether. Okay, don't mix these two things up. The rate at which banks borrow from one another is the terminal rate. It's the rate at which the interest rate policy is set at. Okay, so then the bank takes that value. Let's say the current interest rate is 4.3%, and it will say, okay, well, we are borrowing at 4.3% from each other as a bank. If we want to lend it out to other people, we're going to charge 4.95%, something like that, because the bank also has got running cost, right? So that's how they lend money to the system. Okay, so you can see it's a trickle effect. It's a trickle effect in which the Fed buys or sells bonds. That controls money supply. When the money supply is contracted or expanded, that affects the target rate at which banks borrow from one another. When that rate that the banks borrow from one another is affected, the consumer gets affected. It is a step-by-step process. Okay, so in order for the Fed to get money back from the system, right? They're trying to pull money into the system. They will have to go into the market and create that operation, and then it will allow that to happen. Now, the easiest way to remember this, and so that you don't get confused and I don't get confused, is when yields, the 10-year yield, if the 10-year yield is coming down, right? The 10-year yield is coming down. That means that the bond prices are going higher. Okay. Remember, yields, that means the rate at which is returned for a bond and the price of the bond are inversely correlated. So the lower the yield, the higher the price of the bond. Okay. The higher the yield, the lower the price of the bond. Okay. And that's your premium and discount scenario. All right. So right now, for example, you can see that this is the 10-year yield, right? And if you want to see it in the other view, which is the bond view, bond price view, right? You can see this is the 10 to 20-year Treasury bond ETF, TLH, okay? Right tail of the bond market. You can see that as the rates will start to be cut, right? As the rates start to be cut and the 10-year yield goes down, the price of the bond will then break out and start heading higher. Okay? So this is the one thing that you need to remember, because that is how you kind of predict where money flow is going to be. So as the Fed announces its operations, it will do two things. The first thing is it will start its bond buying program and bond selling program, right? Which in this case, it'll be bond buying, because they will take in bonds and they will give money out. That's quantitative easing, right? So buy bonds, put money into the system, right? And they will buy these bonds usually at a premium because they were higher yields, right? And then you will see that a lot of bondholders will start crowding the bond market, okay? Because what happens in this is that majority of people will start trying to front run the Fed. They will think that the Fed is the biggest buyer of bonds, so therefore the Fed's going to buy a shit ton of bonds. Let's go buy bonds so that we can drive the price higher, and then we get capital gains on that. But remember that there is an offset to this, because what will happen when the price of the bonds go up? Somebody tell me. When the price of the bond goes up, what will happen to the yields? Anybody? The yields will come down, right? So as they're gaining capital gain on the bonds, that means the price of the bond will increase, the yields will come down. That means the coupon payments will start to get lower. And so over time, you will have this equilibrium in which the bond market will say, okay, we've had enough of this. We are stuffed enough with bonds. Okay. Now, remember that in these inflationary environments that we were in for the past couple of years, were actually very good for the US debt. When everything is priced higher, the government collects more taxes. When the government collects more taxes, they can lower their debt levels. Okay. And you can see that some of that has been kind of working as well, hand in hand with the tariffs, right? This is the balance of US trade. Okay. Over the years, you can see that US trade has never been its strong suit. It's always been down and down. We've been in a trade deficit for a very long time. And that continues still today. In fact, the deficit was really bad right after Trump's policies. Then he announced tariffs, right? And everyone started focusing on the trade balance. And now this is stabilized back to about 60 billion or so per month, right? So you can see that right there. So, but this creates tax revenue for the government. And this allows the government to then reallocate that capital to either pay down its debt, which I don't think the US is doing right now, but they are trying to, right? And by the way, there is no argument to be made here whether Republicans are better at managing debt or Democrats are. Both are equally shit. Okay? And I have numbers and facts to prove this. They are both equally shit because they both just take the policies that they want to serve as a party and they borrow against it. It's really simple. Okay? So both parties are shit at managing debt. Okay, so do we understand how the monetary system works? Because then I'm going to start relating it back to equities right now. If you understand everything so far, just drop me a quick yes. Okay, great. So now let's talk about how this affects the stock market. Okay, so when we see that the US Treasuries, the 10-year yield, right, are on its way down, for example, right, entering a phase of quantitative easing, right? Remember, the yields move down, that means the bond prices move up, right? Not quantitative tightening, which is where we were, right? And for your information, zoom out a little bit on the 10-year yield, and then you will start to understand where we are in the cycle. If you have watched Ray Dalio's video on the economic cycle, this will make a lot of sense to you right now, right? Think about 2020 in March when COVID hit. The 10-year yield was at 0.422. Okay. Very, very cheap borrowing. Okay. But then exactly 3 years later, in 2023, October, the 10-year yield was at 5% almost. So you can say 10 times, right? And a lot of people at that time were saying the Fed is increasing interest rates too quickly. But no, the reason why this happened was why? Because of inflation fears, right? There was a lot of inflation fears, right? So I've kind of earmarked all of these different news and events that happened. You can see here, the rates rise. Why? Because of inflation, unstable inflation. Then rates came down. Why? Inflation fears cool. Rate cuts were starting to be priced in, right? Right here. Then again, Trump took office. Then there was the fear of Trump inflation, right? And then now the first rate cut is projected. And you can see we are not even back to where we were, right? This is when the first time rate cuts got priced in. Now, this was 2024. Remember when I told you guys there was 9 rate cuts on the table? Now the first rate cut is being projected and the market's not even there, right? So the market is scared. Genuinely, they do not know what is happening. Now, just to put this into another view, right? This is the probability of Fed cuts in the next couple of months. So in September now, it's at 87.6%. 2 weeks ago, this was 92% or 90-something percent. Then in October, the chance is 50-50 to be the same rate and 46% to be another rate cut. Then in December, the rate cut now shifts to a potential rate cut. Then in January, they're thinking another rate cut potentially. But you can see none of these numbers are firm. The only one that is certain right now is September. And this is why, from my perspective, I can accurately guess that this year we will likely land only at 1 rate cut versus the 2 that everyone is projecting. And you realize I always said that it's either 1 or 2, but likely to be 1 because everyone is so uncertain about the economy. Okay. So how does this play into the stock market? Well, what happens when interest rates come down? How does that affect different asset classes? Let's talk about how it affects stocks first. When stocks are met with interest rates coming down, businesses can borrow at a much cheaper rate. Small and medium businesses, especially, can borrow at a much cheaper rate, which then allows them to expand and grow, right? So if your cost of debt is lower, you have less constraint, and these are what we call looser financial conditions. So how do investors think? They think that if looser financial conditions are around, businesses have more money to have more cheaper money to borrow. They can expand better, they can do things better. But remember that investing in a shit business in a good environment is still a shit business. Okay. So if you go and put all your money into a shit business like Beyond Meat, for example, right? Which case in point, there was one guru that was going around telling everybody to buy it, I think, and was telling me about this. I don't know much about him, but this happened, right? If everybody keeps telling you go and buy Beyond, it's gonna rise by 50% because of the Fed rate cuts. You you need to think about what this person's saying. If it's a shit business, it's gonna remain a shit business. No amount of money you put into it is gonna improve it. However, if you have a business that is actually pretty good, right? And then liquidity becomes cheaper, then that's actually going to aid the business and that business will start to do well, right? So the main thing I'm trying to get at here is a shit business in a good economic cycle is still a shit business. But a good business in a good economic cycle can make wonders. That business can grow, it can expand, it can really give you returns to shareholders. Okay. So that's how this relates to the equity market. Okay. Now there are other markets and how it'll relate to that as well. Now remember that the reason why the Fed has such a difficult time right now is because the labor market is very strong. And then at the same time, inflation is a bit sticky. And if the Fed decides to cut interest rates at a time when inflation is sticky, what's going to happen is that they will find that inflation will start to rise again. Because remember that when you loosen financial conditions and everything's cheaper to borrow, more people will borrow, and that will increase the price of things. Okay. Assets will start running, right? Stocks will start running because there's a perception that they will start growing. Okay. And so this is how the effects of it work. Now you have to have the judgment, a good judgment as a long-term investor as to what is a good business and what is a poor business. Okay. And so that's how this whole thing is related to one another. You will see stocks like NVIDIA and Tesla will really expand during this time, right? You'll see stocks like Win, which are very capital intensive and casino related, will also expand because money will be cheaper to borrow, right? You'll see stocks like Adobe perhaps struggle a bit more, maybe because their economic moat is not as competitive anymore, right? You'll see companies like Amazon also expand in valuation during this time because they have a very clunky business that's a lot of moving parts, right? A lot of machinery and stuff like that. And that's all going to take a lot of money to run, right? So understand the nuances between this and understand that there will be different sectors within the market that will benefit from this, and there'll be sectors that will not benefit from this. For example, will the utility sector be strongly beneficial from this entire cutting cycle? Probably not, right? Probably not, because this is a very stable sector, right? Will retail be affected? Maybe, maybe not, right? This is a tough one, right? Will consumer discretionary be affected? Hell yes, because now cheaper money to borrow means people can actually be discretionary towards the things that they want to buy, right? And this, by the way, the leaders of this sector is Tesla and Amazon, right? Energy sector, what about them? Well, you can see the energy sector is already rallying ahead of the news because what is this sector intensive for? Capital, right? And what is crude the most valued in? Dollars. What is there going to be more in the market? Dollars, right? So the price of crude will obviously have a little bit of a resistance, but at the same time, these businesses, Exxon Mobil, Chevron, Vale, they will have cheaper capital to build more oil wells, do more exploration, all that kind of stuff, right? So understand how this impacts all the markets. When interest rates are cut, it's a big move. It's a big thing for all markets, and you see that everything will adjust. Okay? So that's a summary of the bond market. There might be things that I missed out. You can put your questions in the comments. But right now, we're going to take a 5-minute break, but don't go yet because we have a small announcement and then you go on break. Okay? So we are introducing the next era of the courses that we had developed at the beginning of this year. Now, I don't know about if y'all have been following along with the journey, but me and Andrew have been talking back and forth about this as to how we can grow both communities in such a way that people are really truly learning, applying, growing without the need for it to be gouging in terms of price. We do not want price to be the defining factor as to whether somebody learns. Okay. This is not our aim. Though we have to keep it at a certain price to make sure that we keep the quality of the product high and not let people in who are just not really serious about it. If you guys know, the Discord subscription for my the price for my Discord subscription has notoriously been higher than most people. Why? Because I do not like the fact that people come in and then become like noisy on the trading room floor and all that. We don't need all that, right? We want serious people who are ready to take the plunge and commit to this learning process. And because that is tough, sometimes we have to create certain barriers to do that. So first things first, there are two courses that are coming up. Surprise. The first one is Becoming a Market Maker, which we already have held a previous edition of. We will be running this before the new course. And I'm going to shift to that slide in a second to give you guys the dates and all of that. But the reason why we've done this is because we received quite a few DMs about whether we are holding another round of it. And we figured that if we are holding a new course, then people should attend the first one. If you missed it, this is the opportunity for you to get in again. Okay, so there'll be two of them. The second one will be Positioning Like a Market Maker. The first will be Becoming a Market Maker. And what will you be learning? And by the way, classes start in 4 weeks. Okay, we will be holding a 25% off early bird sale. You will use the code EARLY. The links and all of this information will be posted after the webinar. Okay, I'll post it on all the Discords, all channels. And this sale, the 25% off, will be until 14th of September, which means 2 weeks. I'm being very fair. This time around, I'm not going to accept late stragglers. I'm going to be a bit more strict on this because the last time, a lot of you like passed the date and then you're like, hey, can I still get the discount? We were nice. We were like, all right, we're still going to honor it. But this time around, I'm going to be a bit more strict because you should be fair to everybody. So I'm going to be fair to everybody this time around. I was a bit lenient the last time, but this time I'm not going to be as lenient. Okay. You sign up before the 14th. That's when you get the discount. If you sign up after, you'll be paying full price. Okay. So here is the breakdown of the two courses. The first one, Becoming a Market Maker, is going to be on the 28th of September, which is the end of this month. And it's a 2-day course. So 28th September and 29th September. Okay. What will you be learning? You'll be learning who is the market maker? How does the market maker get paid? What is the market maker's incentive of getting paid? How does the market maker impact price? We'll also go over unusual options activity, which are usually options that market makers are putting on to take advantage of the process. Okay. And we'll talk about how to recognize these and how do you use them. Okay. And this course is both courses are the same price, by the way. It's $291 after the discount. You need to enroll before the 14th. Okay. The next one is Positioning Like a Market Maker. This is also a 2-day course. It's a week after Becoming a Market Maker. It's a 2-day course. So the 5th of October to the 6th of October, same time, 7 p.m. PST or 10 p.m. EST. And in this course, you're going to learn a more deep dive of intro to sell side on derivatives, which means options, right? What is the sell side of options like? We're going to introduce to you what spreads are. We're going to go over advanced option strategies such as straddles, strangles, covered call, wheel cycle, iron condors. We'll talk about all of those. We'll talk about the 3 premium wheel cycle and the 5 premium wheel cycle. We'll be talking about how to risk manage those positions and how the news manipulates these cycles. Then we'll also talk about how do you construct multi-legged positions for your portfolio. For example, if you own 100 shares of something, how are you going to run a wheel on it so that you are really extracting the maximum value of holding those 100 shares? Okay. So same price, same thing. Okay. So that's what we have in terms of today's announcements. We'll have a 5-minute break here, and then we don't have a lot to cover. After this, we're going to cover the wheel cycle. So approximately about 30 minutes more of lessons before we continue. Okay. So for those of you that are planning to sign up for the courses, can I get a quick show of hands of how many of you are planning to do the bundle versus becoming a market maker versus positioning like a market maker? Can I kind of get a good sense here? Because I initially was planning to open up 20 to 30 spots, but I want to see what the demand is like so that I can kind of know. It's 291 each. And if you take the bundle, it's like 25% off on both. So do the math, add 291 plus 291. That'll be the bundle.
Yeah.
Okay, so bundle, are they doing both positioning only bundle, second course, bundle, plan on becoming a MM, first course, positioning. Okay, cool. Now, for those of you that are thinking of doing just the first course, I'm gonna say it's probably a good idea for you to do both. Just saying. The reason for this is because they will be 1 week after the other week. Your learning will not be gapped. And the second thing is we don't actually know when we're gonna run another becoming positioning like a market maker course. I'm just putting it out there. If you are signing up for the first one, I would say it is a good idea for you to take both of them together. Of course, I understand some of you have monetary concerns, and it might be a money issue, it might be a time commitment issue. Whatever the issue is, DM me about it. Let's talk through it because I know that you might think like it's a difficult thing for you to take on, but trust me, once you're completed with it, you're gonna feel so much better about what you understand about the market. Okay. Okay, so we have quite a fair amount of people that intend to participate. So we will probably post all the links after the webinar on both Discords. Let's go ahead and take that break right now. So let's do a 5-minute break and come back. Is that good for everybody? Go get some water, walk around. I know there was a lot of information to take in. I'm going to pause the recording here and then I will convene after we come back. All right. Okay, so we're going to move into the next part of this where I'm going to give you a slight introduction to the wheel cycle. This is a preface into the course. Okay. This is also going to kind of really open your mind to the nuances of how market makers manage positions, how they're constantly shifting their positioning style in order to make the maximum out of every situation. Okay. And so you guys would have seen that I've posted this before. This is how market makers are typically performing a wheel cycle, or how they are typically getting involved with the markets while staying delta neutral or not taking on so much risk. Okay. So you would realize that this is the average, like let's say this is a normal stock chart, a candlestick chart of whatever ticker symbol, doesn't really matter, right? And you know that there are key pivots for liquidity on either sides of this range, right? You could call it Tesla or NVDA, whatever stock, right? And then you see moments in which you have where liquidity bleeds out below a key pivot point, but then very quickly reverses. Earlier, somebody was asking, what is liquidity engineering? That's liquidity engineering. It's when you have a key pivot where there are a lot of sellers sitting in this area, right? And they are saying that if price goes lower than this key pivot, then what we are going to do is we are going to take on that risk and we're going to punish retail traders for being greedy. So when price breaks below that selling pivot point, all those sell orders that were trapped here who are anticipating for price to go further down, they get activated because they have either stop losses or they have buy limit orders set up in this area. What happens is the market maker recognizes that there's a lot of people in this specific area either looking to short or get even lower in terms of exposure. And what they do is they will punish those retail traders or traders to begin with, and they will basically do 3 things at the same time. First thing that they will do is, because prices are going down so sharply, they will start to sell puts. Okay. And when we say sell puts, this is because everybody is buying puts, right? So because they are anticipating prices to go further down and they have sell orders. So what happens here is the market maker recognizes that there's an increased concentration of people that want to go short, and they will punish those people. How do they do so? They sell puts to them. Okay. So everybody who's buying puts, they'll be buying those puts from the market maker. Who is the market maker? It's your broker, right? Or it's another institution. So there are many different types of market makers. Okay. And so when they sell puts here, they will collect a premium. Okay. And now when they sell those puts, if those puts do not get assigned, they will then collect that premium and those puts will just expire worthless. Because what they will typically do right after that is they will go ahead and they will buy calls. That is these two positions are actually same in terms of direction. Okay. So when we're talking about, when we're talking about this, okay, these two are the same direction trade. Selling a put is bullish and buying calls is bullish. Okay. So these two actions are operating together in tandem. They will make money by selling those puts, and then those puts expire worthless, and they will then buy calls on top of that, because what they will then do is gradually buy equity to drown out all the short sellers. Okay. This then allows them one premium here, another premium here, and then capital gains here. Okay. Very simple to understand. Okay. So then price reverses in the opposite direction and then pulls back. This is where short holders are like, oh, look, it made 3 consecutive lower highs. Let's go buy more puts. Well, market makers like, you want to buy more puts? Here you go. They keep selling them those puts. Then the premiums start to rise. More here, right? They earn more on the calls. They earn more on the put side. And they continue to gradually buy more equity, causing this. Now, what happens to these short sellers that are here? They're trapped, right? They've bought puts, which are now at a 50 to 60% loss. And their equity is also drowning. So the ones that do not have the understanding of how things are working, they will then close out their positions. Now, guess what happens when they dump those puts and they dump those equity? The price goes even higher. Because the opposite of closing out a short position, the mechanism of it in the market is a long. When you close out a short position, you are literally buying shares back. And that mechanism causes price to go even higher, which then causes people to speculate more to the upside, which then causes people to buy calls, which then makes the entire system reverse. And we get into what's called a delta positive environment, which then leads to a gamma positive environment, which causes a self-fulfilling prophecy for prices to keep climbing higher. We see this all the time. Andrew points it out multiple times during a week. Okay, when he's looking at the data with SPY, he's looking at the data for individual stocks. He gives you the gamma exposure, he gives you the delta exposure. He tells you whether you're in a positive or negative gamma environment. That's why that information matters. Okay, now what happens when the market maker has now achieved this, and this? Well, prices are now rising higher. They've accumulated profits. Well, when they're approaching the upside pivot, now retail traders are thinking, prices are going to break to the upside, right? So you break the key pivot and retail traders are now buying calls, right? Well, guess what? Guess who is selling those calls to you? It is the market maker. They sell calls to you at that moment, right? And what do? Through this, they will then buy puts, because now they recognize that there is a group of people above this key pivot that are now greedy for the upside. It's the exact scenario from the downside repeated on the upside. You go from fear to greed. Okay? So when that moment happens, the key pivot is broken, right? Retail traders are busy buying calls, which market makers are selling to them. The market maker is busy selling calls to them. At the same time, they buy puts because now they recognize that there's a sense of greed here, and therefore they want to push price the opposite way. This is when market makers will not yet sell their equity. They will continue to accumulate puts. They will continue to sell calls, get premium here, get premium here, get premium here, a couple of times, this typically creates a range. What does the retail market look at this and say? It's a bull flag, right? This is how things get misconstrued in the stock market. It is the key example that I can give you. Now, when that is achieved at peak and market maker realizes that people are not as greedy anymore, they then start gradually selling equity, which then causes price to break down. And then their sold calls are now generating additional premium, and their puts are generating additional premium, causing the system to completely flip and go the other way now, because now you've entered delta negative environment, which is the gamma negative environment, which is now going to create selling pressure on the market, which is then causing price action to move the complete other way. So how does the market maker achieve this? Well, it is through a series of steps which you're going to learn during the course, but I'm going to give you a preview right now, okay? So this is what we call the 3 premium wheel cycle, okay? How does it start? Well, it starts with the market maker selling puts, right? So they sell puts, and when you sell puts, what happens? 2 things happen. There's only 2 outcomes. Number 1, the stock moves higher, or the stock moves lower, right? So if they sold the put and the stock moves higher, this is a positive outcome for the market maker because those puts are going to expire worthless. They then accumulate 1 premium here. Follow me so far? Now, if the stock moves down against the market maker, which we have seen this over and over again, it's a constant process. Andrew highlights this every single week. If you're in the webinar sessions every week, you know this happens, right? If the stock price moves down and they're sold puts, the market maker has now negative exposure. But in this case, their puts get assigned. Remember that even if the put is assigned, they still collect the premium on the puts. It's just that now they're going to be long 100 shares along with that. So let's say the put they sold was at $5 per contract for a specific equity. Okay, I don't know which equity. Pick one, doesn't matter. Well, they would now be long 100 shares of the stock, less $5 in premium per share. So if they bought the shares at $100 per share, which multiplied by 100 shares is $10,000, right? Then each share would be less $5 in premium, which means the net proceed per share was $95 is what the price was, because they have taken $5 in premium for the contract, which represents 100 shares. Does everybody understand this so far? If you understand it, say yes. This is really important that you understand this part right now. Okay, great. So now the market maker is long 100 shares. Okay. Now what does the market maker do? Well, if the volatility, the expectation of the stock moving up and down is very high, then the market maker will go and sell a straddle. What is a straddle? A straddle is when you sell both a call and a put at the same time. Huh? What do you mean, T? How does that even make me money, right? Can anyone just go and do that? That means tomorrow I just go pick a stock and I sell a straddle and all of a sudden I'm profitable? No. That only works when the volatility of the scenario is high. Market makers expecting that the price of the share will be volatile. That means it can go up and down very quickly. So in this scenario, what happens to these contracts? Both the calls and the puts are expensive, more expensive than usual. This is when the implied volatility of these contracts are high. So the market maker takes advantage of the situation where everybody is overpaying for calls and puts, kind of like the scenario which we were at earlier, right? This one, right? So when either here, down here, the puts were very expensive, or up here, the calls are very expensive. Well, market maker knows that the expectancy of this stock moving is either plus 5% or minus 5% for this week. So when Andrew gives you that plus minus figure, that is very essential information, because that's exactly how market makers try to predict where the stock will be in a week from now or in a month from now, depending on the expiry, right? So here they sell the straddle. And that means that they sell both the call and the put, right? And so once again, there are two scenarios here. The stock either moves up or the stock moves down, right? If the stock moves up, then what happens? The put expires worthless, right? And then the calls are assigned. If the calls are assigned, means that this 100 shares are taken away because the call has now been assigned. When your call is assigned, what happens is that you need to have shares to support those calls. Unless you're a brainless retail trader that takes naked positions. That is not how things go in the real world. Okay. So many of you trade naked calls and puts. You buy calls and you buy puts. That's not how the market operates. Derivatives were created as a risk management product. It wasn't created as a speculative instrument. Okay. Now, if the stock moves down, then guess what? The call expires worthless. But then you have now received two times premium because you receive one premium on the put side and the one on the call side, which expired worthless. So you now have two premiums, but then your put got assigned. So you have now 200 shares instead of 100 because now the put got assigned, but the call expired worthless. Here, the put got expired, the call got assigned. So you minus 100 shares. So now you have no shares, but you have accumulated three times premium in this process. At any given in this moment, the market maker has been completely in control of the position and the market environment. There is no position here that the market maker does not accept. This is all known risk and has been designed in a way so that they can maximize income from it. Okay. Now, I haven't put the other cycle from here. This goes on because from here, if you're now put assigned at 200 shares, you now can turn around and sell two contracts of something. You can, in fact, sell another straddle, but this time sell the straddle for two more times. So I will go through the 5 premium concept in the course, and we'll be going through scenarios, and then we'll be also going through examples of how to apply them. Okay. So this is how the market maker operates. They're not looking at individual positioning. They're looking at the whole big picture. Where are things in perspective to the entire market? Okay. And if this opened up your eyes to understand that how complicated positioning can be in the market, then I would love if you said something because I don't know if you are understanding what I'm saying. But this is a good insight. I'm going to stop here because we are also running out of time. So I'm going to hand over the next part of this to Andrew, and he's going to go over the reality between social media and how things go.
Yeah, so we're going to bring it full circle, right? So at the start of this whole webinar, we started with retail mindset, data mindset, right? Now, for you guys that know me, you know that I like to be incognito and go join some of these trading groups, right? And evaluate their strategies and the success of their strategies. And so we wanted to talk a little bit about what do we see, we saw the retail side. So what do we see from those trading strategies and what does it actually look like, in reality? Now, if you use these strategies and they work for you, fantastic. I'm not saying these strategies don't work. I'm just shedding some light into things that might get missed. So on the left side, you have, you know, three different social media traders that all use the opening range breakout as their strategy. And this is just some of their content that they've posted on social media to try to feed people into their group. So as me and T have talked about, right? T talked about in the announcement that, he's very particular about who joins his group because he wants to keep it, very tight knit to serious people. If you know me, I do zero marketing. So you can't even get into my group, even if you wanted to. You can't find it. It doesn't exist on social media. The only way you can get into my group is if you know somebody who's gotten into my group. That's the only way that my group grows. And I do that so that everybody is tight knit, we're all connected, and we can all work together and grow, right? So, but these people, they're trying to push marketing campaigns. So, what do we see? Traders are making huge piles of cash with the orb. What do we talk about when we said, retail traders? Fast money, right? What do we see in the second image? We see a guy posting an image of P&L on a repeat, right? Obviously, that's not real market. That's a recording because it pauses during the video so he can talk about it, right? Which is not a real market. Don't we all wish we could pause the market and evaluate the candlesticks and then make our decision? Yeah, it'd probably make trading a lot more easier if we could do that, right? This bottom left picture, he says, Chat GPT confirmed my trading strategy is profitable. You know what? I don't think I've ever typed my strategy into Chat GPT. Um, and then the last one is him doing a repeat video, again, a recording video of the 15-minute orb. So we're going to take a look at the 15-minute orb, and I'm also going to show you guys some data points and how the data points also affected the trading on that day and how you could have used that information. Now, the interesting thing about the 15-minute orb is if you look at smart money hours, where does the 15-minute orb opening range breakout fall? It falls in a particular category that's pretty interesting. At least to me, it is. Right? If you look at the smart money hours, the 15-minute orb happens in the amateur hour, where market makers take the most advantage of traders. Now, I've been in the live groups with a lot of these gurus because in my free time, I like to spend a couple $100s a month and just join these groups and just listen to them and sometimes make fun of them in the groups and then I get kicked out. But a lot of the times when their 15-minute orb strategy doesn't work, they default to, well, today's just not the right day, man. Like sometimes it's just not the right day. Normally, back in February, we were fantastic. I don't know if you guys remember, but in February we were making a killing, and we're like in July. I'm like, dude, everybody was making a killing in February, you dumbass. Um, but essentially, right, the strategy doesn't work, so they gotta fall back to when the strategy did work. And a lot of the times it doesn't work because the conditions aren't correct, right? The data doesn't align up. And then the data starts to line up and the strategy starts to do well again, right? So let's take a look. Right, I'm gonna share my screen. Replace current share. There we go. So you guys should see my screen now. And we're just going to take a look at this. So we'll just do the week. Nothing too crazy here. So what's this? Tuesday, Monday. All right. So if we look at Monday here and we use the opening range breakout, the first 15-minute candle would be right here. So this would be their strategy. And so what would probably happen is they like to downsize to like a 5-minute candle. So either they would have got tricked here and then entry would have been somewhere around here. And I guess you could say it was positive, right? That's a nice quick little scalp. Not too bad. If you're looking for little scalps there. But in reality, where was the real trade? The real trade for the week was actually, or for the day was actually here. So, and where does that trade fall? That trade falls into the institutional positioning hours, right? And one thing that we would have known is that there's a $7 billion dark pool zone right here. And so the easier evaluation would have been to go short and use the dark pool zone as a stop loss, which I think is what we did that day, if I remember correctly. Right? So the 15-minute candle breakout would have worked to an extent. Again, I'm not saying these strategies don't work. I'm just saying there's other pieces to the information. Here's another one, right? And again, you can see institutional hours are where the breakout and the bulk of the move is happening that day, right? So amateur hour, again, here's your 15-minute candle. And what do you see the market makers do here? You see them sweep the low, right? What did T just talk about, right? How they engineer that liquidity so that they can get people moving in one direction and then move it in an opposite direction, right? And so if you got in, you probably would have got in somewhere around here. You would have been down in your position for quite some time. Maybe you held your position. Then you would have probably been back to about flat on your position, depending on what kind of contract you were doing. Then you would have been down on your position again. If you're holding a 0 day, you probably would have started getting anxious here because you're getting close to the back end of the day and theta starting to eat your position away. And then into the tail end of the hours, that's when the institutions stepped in and pushed the price to where they wanted the price to go, right? So again, would the trade have worked? Possibly. Now, I like to use pre-market zone because if you've ever watched the video of Confessions of a Market Maker, you'll know that they talk about how they actually manipulate the price in the pre-market. And so if you look at the pre-market price action, you'll actually see that they hold the high of the pre-market the entire day, right? That was your pre-market high right there. They actually hold the pre-market high, even this candle right here, right? The liquidity sweep, you can see that they buy it back up and they close it above the pre-market. And then they come down and they back test the pre-market high and then they run it to the upside. So I personally don't use the 15-minute orb. I use the pre-market price action, which you could also call London session for people that trade futures. But essentially, I do that because I know that market makers can essentially control price in the pre-market. So it gives me an evaluation of the range that the market makers are saying is the kind of the safety zone. Um, and then if you get out of that zone, that's when you get your large moves. So this would have been another example. Again, I'm not saying the 15-minute wouldn't have worked, but it wouldn't have been as highly successful as some of those videos that you see on social media would make it out to be, right? Here's another one where, again, you would have spotted your 15-minute candle, which would be here. You can see that you kind of spend some time in here and then you close above. So that would have been your entry. And if that's your entry, then you would have hit this dark pool level right here, rejected that dark pool level, which was 1.4 billion, and came right back down into the area. Are you going to hold your whole position this time? Maybe. If you didn't, then you would have caught a nice little move here. Again, institutional hours is where you get the bulk of your move, right? So go back to those smart money hours and where you're seeing things. And then obviously this was NVIDIA's earnings. So that was kind of a one-off, but look where NVIDIA's earnings bounced. So if you guys don't think that these individuals are in control of the market, why does the price bounce off of all of their levels at when all the news comes out? Right? They're just moving the price to where they want it to move. And we can even spot, I can show you where these orders came in. So like this price is 643.22. So if I go into the dark pool, right? And I look at that price particularly, I go into my dark pool channel. I can find the order because I have them all. So 644.78, 648.87, 646.63, 645.41, 642.78. Let's see. 645.30. What are we at? 643.22. 635, 638, 639, 643.37. No, getting close. 643.22. There it is. $3.1 billion. So that order was placed in the dark pool back on August 16th. That price bounced off of it on August 27th. So you see how long that price was in place, and still, where's the area that it came to? So the individual that probably bought this area was back from the 16th. right? And this is why data is so important because it helps you understand what's going to happen next. And what happened next after they bounced there, they pushed it all the way back up to almost 650. As you guys know, gamma level 650 was our end of the year target that we've been talking about for countless times. So again, right, data giving you insight into where price could possibly go. Now, again, if we take a look at the 15-minute here, we see the same thing, right? Here's your 15-minute candle. Now, here's where the market makers push price down, moving everybody in one direction. And what do they bounce off of? They bounce off of this 645.41 level, which is a zone of $7 billion. So what happened here? They pushed price down. They got everybody moving short. They then stepped in, bought their shares, bought their calls, and then what did price do the back end of the day? It moved to the upside. So again, not saying that the opening range breakout doesn't work, but it's not the main move of the day because it happens in the amateur hour. Now, if you took a look at pre-market, which is what we use, you actually see the first thing they did before they did that sell off is they swept the pre-market high right there. Then they sold it off. And when you look at the pre-market, you can see it's a nice little liquidity sweep here. And you can see that the candle closes back into the pre-market range. And then there's your move to the upside. So again, who's in control of the price action? The market maker is. Once you understand that the market maker is the one who's controlling price, you stop worrying about all the things that all these social media trends are telling you, and you focus on how do I better understand how the market maker positions himself? And then can I be a part of that trade? I want to be on the side of the market maker, not on the side of retail. So if I'm on the side of the market maker and I'm trading with him or that computer versus retail, there's a higher probability that I'm going to catch the real move versus scalping the engineered liquidity move or trying to scalp the potential trap, right? I'd rather be on the side of the real move. So again, you're going to see a lot of this stuff on social media, fast money, cars. The strategy has a 90% win rate, right? All the stuff that they want to sell. But when you start to look at the actual data and what the data is telling you, and you can just see it. I mean, it's constant. Here's Friday. We came down, we tapped this golden pocket, we tapped this dark pool right here at 4.1 billion. And where do we close the day? Rejecting this dark pool right here at 7 billion. So again, these levels are where the institutions are buying and selling shares. And so once you understand what you're looking at, then it's a lot easier for you to apply risk based on that information. And this is what we're going to go into heavily in the first one, in the becoming a market maker. This is where we spend countless hours diving into what is the dark pool? Why does the dark pool work? How does this relate to gamma exposure levels from the options chain, right? How do we better understand wave structure to be able to decide if we want to take risk or not? This is the types of things that we're going to go over deep in that class and spend a lot of time examining so that when you guys get into the market on a week-to-week basis and you read the playbook or you join the Sunday night sessions or you join the pre-market sessions, you have a better understanding of the data that I'm talking about, as well as how to use that data within the market on a day-to-day basis. So the last thing I'll just say, just to tie it back to what T talked about, the second server, which will launch next year, um, this one is just about monthly positions. And as you guys know, a lot of these things hit their targets, right? Google at the start of the month was back here, right? We had target of 207, 178. You can see it was currently sitting at around 193. And you can see where it ended at 212 and hit its bullish target within the range, right? So understanding the implied volatility of contracts, understanding the time frame in which you're looking at is very important to deciding if you want to take risk or not. based on that name. So that is all I have for you guys. I know it's been an hour and 46 minutes, so I don't want to take up too much time. I want to thank everybody for joining us and for those that hung out for the full time. I hope you guys took some things away. Again, the biggest thing for me and T here is just to open people's eyes to how all of this works so that you guys have the information that you need in order to be successful. Um, and I will continue to join these Furu servers because I actually get a kick out of it. It's kind of fun. I have a few on my list that I need to join this month. I've just been so busy. I haven't had opportunity to. So I will be joining some more servers to copy their trades and see how they go. And then I usually like to look at their social media posts and see. Usually, like they'll take a trade, I'll take it with them. It won't work out, and then I'll look at their social media and they'll post like a winning trade from like a month ago,
Oh,
and
one
they'll
thing
be
that I forgot to mention, for people who are planning to sign up for both courses, I'm gonna still hold the existing thing that I did for everybody, which is you will get access to module 4, which is the options mastery course, which we
yeah,
had prior. I think it's very, very important that if you're going to embark on learning about options, then you still have the ability to learn it fully. So I'm going to still let module 4 be accessible to all of y'all for free, completely free. You do not need to pay for it. And that will give you, that is your pre-requirement. You have to do that before you take both of these courses. Okay. So
yeah,
I'll post a link to that when I post the sign up. Sign up's going to come out like within the next couple of hours. The recording of this entire video will also be up within the next couple of hours as soon as it gets rendered and all that. So I'll post it on YouTube and it'll be available for everybody to look at. But thank you all
yeah.
for attending, staying all the way to the end. I think at peak we had like close to 50 plus people viewing this, and so it was great, great success. And we will see you again tomorrow. Same time, 7 p.m.
Yeah, it might be. I mean, unless I go play hockey, then I'll probably
Okay.
do it sooner.
Okay. If not, it'll be pre-market, basically.
Yeah, or we'll just do it tomorrow morning,
Yeah.
pre-market, either or.
So either way, we'll be doing the weekly breakdown either tomorrow, 7 p.m. or the next morning, pre-market. We'll
And then
be
keep in mind, it's already posted. Like, real quick, I'll just show it to you guys. So for the people that are on the server, I think I posted in your group too, T already.
yeah.
So for you guys that haven't, make sure you guys go read it. Playbook, we did not hit our target last week. Our 4 week streak was broken. Um, but I must have accidentally posted. Did I not post the playbook? Maybe I haven't posted the playbook yet. Oh, it looks like I got some homework to do. Well, there we go. I gotta put the playbook together.
Yeah, there you go.
So I did do the target and I did do the chart. So I have all the data. I just need to post it. I totally thought I did. I don't know why. I guess I didn't. I totally thought I did. So I'll post the playbook. I haven't posted it yet. My bad.
No worries.
Good to know. So yeah, I'll get that done probably tomorrow morning. And then yeah, we'll either do it tomorrow night or Tuesday morning.
Yeah. Sounds good.
All right.
Then yeah, you guys have 2 weeks to sign up for the course. After that, it'll be full price. Please don't do that to yourself.
Yeah.
And
I'll do that.
I have to be strict this time because last time it was not fair.
Yeah.
So this time, be more strict. But thank you all for attending. Thank you for your time. We'll see you soon. Take care. Bye-bye.
Later.
Later.